Okay, now we're going to look at a market strength calculations. We're going to look at the price to earnings ratio and the dividend yield ratio and see how our company is doing from a market strength perspective. So again, we're going to start out our ratio or our calculations with writing down the formula, which is the market price per share over the earnings per share. So we're going to find this information on the market price per share in the Wall Street Journal. We're going to find it online where we can pull up MSN Finance or Yahoo Financing. Just literally get the stock price for the company as of the date of the financial report. So we find that with this company that we're dealing with right now, their the market price of their shares as of the fiscal year ended on 2012 was $20. And then the earnings per share were $2.80. This yields a price to earnings ratio of 7.1 times. And then we see that in 2011 their stock price was $30 and the earnings per share was 2.8. And so in 2011 it was a little bit stronger at 10.7 times. The market price was 10.7 times the earnings per share. And then looking at our dividends per share, our dividends yield, we're going to look at our dividends per share divided by, again, our market price and our dividends per share, as we can find in our annual report. We can calculate that by taking the dividends per share, calculating the dividends per share by taking the actual dollars they distributed in dividends and the number of shares outstanding, which is 12,000 divided by 10,000, and this gives us a dividends per share of $1.20. Okay, so we take that $1.20, we put it over the market price of $20, and we get a 6% yield. And then for this same time period in 2011, they had similar dividend levels. They had issued the same level of dividends, $12,000, and had the same number of shares outstanding, so it was still $1.20. But in this particular year, they had a market price per share of $30, so a little bit higher. Okay, so what we can see in the price to earnings ratio is that the price to earnings ratio shows that maybe there was a little drop off or decline, a little bit of a decline in the investor maybe confidence in the company, and so that's why the price to earnings ratio went down. And then as it relates to, and that could be because of maybe the cash flow weakening or whatever, that we saw some of those other numbers and stats, the profitability went down. So the market may be reflecting that the company's strength is not as good this year as it was in the previous year. And then we look at the dividend yield, it increased as a result of the drop in the market price. So because the market price dropped, this seems to be looking better, but it's really because the market price dropped a little bit. Okay, so this is one of those measures that you need to be careful of reading into it and looking at it so favorably unless you understand what the numbers are behind it, because their market price dropped, and so therefore if their dividends per share stayed the same and the market price dropped, it looks like it's stronger. Okay, so you just need to be wary of that. Okay, alrighty, that's about it on the ratios. If you have any questions, let's talk in class.